It is now my pleasure to turn today's program over to John Strauss. Sir, the floor is yours.
Welcome, everyone. I want to thank you all for joining us for today's webinar, Introduction to Updated ASTM Guides and Next Generation Tools for Training and Reduction of Environmental Liabilities. This is the 81st in a series of webinars that Exponent's produced on topics drawn from our multidisciplinary consulting practice. This has been approved for 1 hour CLE credit by the state of California. A certificate of attendance will be issued to all participants with credit or for use by individuals to make application to their home state for comparable credit. The presentation slides will be sent to all of today's webinar attendees. The recording with the presentation slides will be available on our website for viewing and listening early next week. One final housekeeping detail before we get on with the presentation. Under the program, a pop-up survey will appear on your screen. It's a simple survey about today's webinar, and obviously we're looking for your feedback, both positive and negative, so we hear how well our presentation met your needs and expectations. So please help us by completing the survey. Now let's introduce today's speakers. Scott, a senior managing scientist in Exponent's environmental and earth sciences practice, has over decades of experience in assessment and management of environmental and product risks and liability for a variety of industry sectors, including source extraction, manufacturing, utilities, and insurance. Mr. Shepard is an expert witness in consulting roles in a variety of litigation matters. ERCI, which helps software and reports to help duty holders understand their environmental liabilities. He's developed software tools to improve capital stewardship, evaluate remedial options, and forecast life cycle costs for large cleanups. Now let me introduce our first speaker, Scott Schock.
And welcome to our presentation on the next generation of ASTM standards for environmental liability estimation and disclosure. My center, John Rosengard, and I spent a good part of this year working on the committees that updated the 2 ASTM standards that we'll discuss today. I look forward to sharing some highlights with you about these updates. The first slide has accounting terminology on it. Do I believe in this webinar? Hold that thought. Let me tell you about 4 things we hope you will take away from this presentation. Generally Accepted Accounting Principles, GAAP for short, is global, decades-long development of guidelines that seek to increase the difference between what is enterprise books liabilities and what market value of those liabilities are. So the key issue, remember, book versus market, book versus market. We'll address this issue from a variety of angles today. GAAP's changed significantly over the past 10 years, which is an important driver for updates to the 2 ASTM standards we'll discuss. I wish to provide you with updated references and resources to help you ensure you are looking at all types of environmental liabilities and the whole life cycle costs. Third, I wish to share with you key considerations that can potentially improve cost recovery, allocation, and insurance claims and claims review. Claimants can benefit by accounting for and recovering life cycle costs, and can benefit by making better, more informed cash out decisions. Fourth, we'll share with you some tools and methods you can use to clarify the market value of your liabilities so that you can better prioritize spending to maximize results for your expenditures and to avoid surprises such as financial restatements. As of the expansion in generally accepted accounting principles, or GAAP, the historical approach of handling environmental liabilities as contingencies evolved into what are now 5 types of environmental liabilities: asset retirement obligations, environmental obligations, commitments, contingencies, and guarantees. Let me cover each of these. Retirement obligations, or AROs, include such things as asbestos removal, lead paint removal, mine closure, or oil well plugging and abandonment. Emissions, an example there is if your company and others sign a consent order to clean up a site, and then And those other companies are counterparties on that obligation. Commitments examples are if your company promises to back facilities if contamination is found by a buyer, or if a company has promises to return leased land without structures on it or without damage after the lease period. Contingency examples include CERCLA past cost reimbursement to EPA or bonus cash outs. And these examples include state-required financial assurance for mine closure, operations, maintenance, and monitoring, or CERCLA financial assurance. These are some examples of environmental obligations, including contaminated soil removal, pipeline removal, sediment remediation, and groundwater remediation. There are some examples of common asset retirement obligations, including removal of creosote pilings, underground storage tanks, lead-based paint, and asbestos. And these are a few more examples of AROs. The MEGS airfield decommissioning in downtown Chicago in 2003, the Pier 48 warehouse demolition in Seattle in 2010, British power plant demolition from 2014 that included this 801-foot tall stack. Definitions in mind, was it necessary to update these ASTM standards? Absolutely. Let's remember our mantra, book value versus market value. The definition itself is challenging, seeing a liability today where there wasn't one before. Liabilities like pension liabilities were historically considered contingencies dependent on some future event. Now, by default, we consider an environmental liability to be an obligation, which is enforceable duty. Enforced, but enforceable, big difference. That measurement has gotten a lot more complicated. We are guided by the phrase probable and reasonably estimable, was used for contingencies. But between 2004 and 2006, GAAP evolved to say that all AROs had to be measured with fair value. What value means? Characteristics of fair value estimates are expected value for multiple scenarios, present value of an open-ended time span of recurring costs, and component costs that are in line with current market pricing. Increasing numbers of environmental regulations, more detection and sensing technology, and more data in the public domain, plus an understanding of counterparty default and remedy failure risks to include. Our takeaway in our framework on these standards updates is that the accountants are asking us to make sure that liabilities are priced with fair value instead of costed out as contingency. Thanks to the vast proliferation of information, tools, and technology in recent decades, it appears the days of the truly unique environmental cleanup with an inestimable value are coming to a close. On the earlier slide, you saw how environmental liabilities are now classified in 5 different categories: asset retirement obligations, environmental obligations, commitments, contingencies, and guarantees. In 1975, all environmental liabilities were called contingencies. The rule, we recognize a liability when it is both probable and reasonably estimable. That line comes from that earlier definition. Back in pensions, post-retiree medical expenses, and product warranty costs were all called contingencies. As you can see in this tabulation, from 1996 onward, the number of GAAP authorities listed on the left side of the table and key documents grown substantially in number, resulting in greater specificity in accounting practices for the 5 types of environmental liabilities. A view of this timeline, which shows the proliferation of environmental and disclosure accounting standards from various GAAP authorities on the bottom half of the figure, in comparison with a timeline of major federal environmental legislation on the half of the figure. I'd like to turn over the presentation to my co-presenter, John Rose. Rosengard.
This is John Rosengard with Environmental Risk Communications in Oakland. Just to pick where Scott has us here, the 5 different types of environmental liabilities are really consistent across the different standard setters that are out there. From left to right, the retirement obligations are defined by one standard setter here in the U.S. called FASB, the Financial Accounting Standards Board. It's specified in something called ASC 410-20. I know we're giving a lot of accounting terminology, but this is where we're starting from in trying to bridge that gap between what's booked and what the market value of the liability is. ASC 410, Accounting Standards Codification, Section 410-20, very clear definition of what auditors should be looking for, what CFOs should be booking, and how to measure those numbers over time. Definitive instructions that goes back to 2001 when FASB Statement 143 came out here in the U.S. For government agencies, your standard setter, your accounting standard setter is called GASB. So if you work for a state, county, municipal government, a public university system, public school system, great. GASB is your accounting standard setter. Here's a secret. FASB and GASB are in the same building in Connecticut, and they share a lot of the same staff. But GASB is a standard setter focused, again, toward non-federal government agencies. Just today is November 17th. Just yesterday, November 16th, GASB 83 was passed, which means that another year and a half or so, all public agencies will have to start recognizing their asset retirement obligations, which public companies here in the U.S. have had to do since 2001. So again, just a sense we want to give you of the evolution. If your company's based out, if you work for a company that's based outside the U.S., your standard comes from a standard called the International Accounting Standards Board, based in Europe, and your key document is called IAS 37 for International Accounting Standard number 37. With those additions of terminology in mind, I just want to give you left to right a sense of what the 5 environmental liabilities look like today, because these different types are consistent across all of these different standard setters that are out there. They've agreed that an asset retirement obligation is called an ARO. An environmental remediation liability or a pollution remediation obligation and an environmental obligation, they all mean the same thing, and they just slightly different references and terminology associated with them. Commitments the world over. If there's a actual commitment between 2 companies, that's got the references from the 3 major standard setters, as well as the setters in Canada, UK, Ireland, and so on. We predate most everything we're looking at here. Those definitions have been solidly in place, as Scott noted before, since 1975. I just want to make sure that you're aware that the current numbering and codification that we've got in place here for FASB, this is from 2009, from GASB, this is from 1984 forward. These are relatively young reference points, but I do want to give you a sense that the trend over the long term is something we want to highlight at the very bottom of the slide, and that's fair value measurement is preferred over probable and reasonably estimable. Reasonably estimable is still allowed. I don't want anyone to leave this thinking their clients or their company or they are doing something wrong. Unreasonably estimable is still allowed, but it enlarges this gap between book and market value. I want to daylight it and say we worked on the standard to really daylight that understanding the space between book and market is an important part of what we all work with. So I just want to bring up a couple of cases where major industrial companies have had some significant environmental liabilities triggered in the past few years. BP had a very serious accident, which is expected to cost about a quarter of its market value back when it happened. And just think of that one event. Aside from the unthinkable human cost, a quarter of the company's value was wiped out before cleanups and claims. 2011, a complicated Tronox bankruptcy case kicked off, where of one business, Anadarko, was handed $5 billion of legacy liabilities spun off by McGee. And that court case took 4 or 5 years to work out. So just the last few years also, we have seen almost all but one of the major U.S.-based coal companies file Chapter 11 bankruptcy and now stuck there because of unfunded contingencies like pension and AO liabilities. Materiality is a common test for looking at environmental issues, and what I want to do next is point out that environmental liabilities are serious for everybody, both as events and in the Exponent ERCI love to do research. We love to take deep dives into the background and make sure we understand context as our background for doing our work. So what I want to do is just say that we did some research before we dove into editing the ASTM standards. Understand where the patterns of reporting stand today. We looked at about 800 financial reports, like 10 reports to the SEC, 20 F reports, and disclosures from about 85 of those reports show the environmental remediation liabilities, or ERLs. We also call them EOs, or environmental obligations on the previous slides. These are the ERLs for 4 companies in the same industry from 1995 to 2016. This is all public domain data. Each balance graphed the same way. We were at the beginning of the year balance from each of these financial reports. We deducted the spending gradually over the course of the year. It's a judgment on our part, but we're just having years here. We put in a single increase, a rebound, or an add back of the reserve at the end of the year, which most everybody did almost every year. And then turned by the brand January 1 balance for the next year. So you see this sort of sawtooth pattern where we're looking at January 1 spending throughout the year, an add back at the end of the year, and starting over the next. From this, are that the balances are really stubborn. No one is successfully eliminating the liabilities, but everyone is really trying pretty hard. If you sum up the downstrokes or the upstrokes with spending or the reserve add backs and don't even add for inflation, each of these 4 companies has spent $3 to $8 billion over the last 21 years. If you have a close reading of each company's disclosed reserve policy, which are often in the 10K reports, you'll see that everyone is saying the same thing. We're using probable and reasonably estimable tests instead of fair value measurement as basis for our calculations and therefore our disclosures right here. I wondered about the meaning of all of that. To see, we once had a $1 million liability a few years back. We've slowly spent $40 on average trying to fix it, and the liability today is $1 billion. We went up the circular logic of that and where ASTM standard work might help. Let's look at another type of environmental liabilities, namely the asset retirement obligations. A few days away in those same 85 annual reports is the data for the AROs, same 4 companies. In contrast to the ERLs that we just looked at, these AROs are measured at fair value, which is mandatory, and is spelled in 2001. There are not 2 ways to do it. It's out in FASB 143. So that's the issues we observed with the previous slide, with sort of the sawtooth format running in place. Here we see this sort of gradual escalation. It's possible if you add up data from 10K reports. No one's publishing this data for 21 years all by itself. But we compiled this data. We came with a couple of questions that are even more challenging than the one we had on ERLs. Number 1, why are the balances growing at 15% a year? Some maybe even tougher. If the balances are growing at 15% a year, shouldn't the spending be growing at 15 to 20% a year just to keep up? Where do those trends lead everybody? Are the numbers going to keep going until they hit 25 or 50 or 75 billion? And when do they get to be enough of a noticeable number on a balance that correct action takes place? A different approach comes into place. Even each company is very serious about these numbers. Each one has spent $6 to $10 billion over the last 20 years. They're serious about working them down, but stubbornly, the long-term trend is pointing in a direction of accumulating liabilities. Here are 2 other examples of individual 10K reports, just to provide you some context of what else you might see in its raw data format. The major oil company on the top half of the screen provides a detailed numerical evaluation of their remediation numbers on the left half, the table on the left half of the screen, their retirement numbers on the right half of the screen, but it's just for 3 years. The manufacturer's disclosure on the lower half of the screen provides 2 years of data. That's even rounded to the nearest billion. Just less granularity, less details, But again, all these are allowed, all these are possible, all these are acceptable. But if you're stepping back as an investor, an acquirer, a creditor, you want that next level of detail. So it's our assertion. Finding these disclosures offline, maybe for several years, is essential to discerning some of the trends that basically are differentiating between what's disclosed and what's known and readily available. Question about the long-term impact, you really do have to change some of your habits and maybe even some of your framework. So over to the long-term impact, and let's put one set of disclosures for a different company a microscope. There's plenty of data if you take the time to aggregate it, but with adjusting for inflation or purchasing power or anything else, look at the simple display of 10K data for 21 years of cash flows for this one company's environmental liabilities. We averaged them out for all 21 years and for the last 5 years, and that gave us the data that's in the blue table in the center right of the screen. The middle column is the 21-year average. The rightmost column is the average for the last 5-year data. So you can see a couple of takeaways. Average spending is around $80 million a year. Reserve add back every year, the same. The average liability balance, about $1 billion, just under $500 million. So investor, which probably includes many people on this call. As an investor in this company, we probably have the same questions. Senior management for as a creditor, we'd have the same questions. And if we were acquiring this company, we'd have the same questions. And they basically go like this. You're seeing $84 million a year. You're adding back $101 million. That's running in place. In terms of performance, it's running in place. So what are we not understanding? That's a challenging question. How do you know if you're delivering value? Do you even know if you're delivering value in the form of absolute liability work down in exchange for spending? Because it isn't clear from this. That may be a great story that you had to tell, but this display, this disclosure doesn't tell us where you're having some wins and where you're having some challenges. Third, if everything is right, it's an accurate number, it's transparent, and everyone can see, validated, and audited. Is there a balance itself, the reserve balance? Is that in the right place on the vertical axis? Is there another decade of reserve add-backs already in the pipeline? Is one reasonably estimable reserve policy? Is fair value measurement? Therefore, we have a space between the book value, our reserve, and market value, which is how a creditor or acquirer would value this part of our business. Fourthly, is this trend taking you where you want to be in the next 5 years? Are you achieving what you want to achieve? So let me go to the third question for a second. Because a core part of our message today, flipping that book versus market gap, or at least having a transparent awareness of why it's there. If spending $84 million a year resolving a liability, but that liability remains essentially the same, it raises doubt whether the liability is in fact only $456 million. Let's take those two numbers that I highlighted, the $80 million, the $456, and do an analysis of what alternatives this might be. That's our book value. That's what we have reserved. That's what's audited, and it's fine. But if we step for a second and say that's based on a policy that a project has to be probable and reasonably estimable to get booked, how do we do that $84 million a year differently if the money was going to another purpose? So the line is if the money is going to environmental liabilities, but if we're seeing $84 million on a pension, we would value that expectation very differently. The data all in a company's 10K reports, the discount rates, the inflation rate assumptions, is all laid out there. What I just want to again point out is this gap between book and market. If the spending, that $84 million a year, were to go on indefinitely and be a pension liability, it would be viewed by anybody $1 billion. If we're dividends going out to shareholders, around $2 billion. And if we were paying off the interest and principal on long-term bonds, we could borrow $2.5 billion worth of bonds and pay them off with $84 million a year. So again, there's all these processes in place that are absolutely known to investors, to Wall Street, to bankers, to other parts of the financial community, and that's where, again, we saw some space for operating on this. If interest in the calculations, we can certainly provide them in more detail, but up ahead to our takeaways, this company's doing what it should, and it's doing what everyone else is doing as well. They're applying different discount rates to different situations. But now to that market test for a second for the environmental liabilities. When someone plans to buy this entire business, including this $84 million a year spend pattern, how do they value this liability? That's their value measurement. Again, the answer. The buyer's going to use fair value to set a market price, which will be in the neighborhood of 1.4 to 2.5 billion if they want to do the numbers producible and transparent way. Second, a seller says to you, we've been spending around $84 million a year on remediation and our whole business for sale. If you're there, would you go back to your board and say, this is no big deal? In fact, $500 million deduction to be on the side? No, it can turn worse than that. First, I hear you laugh. There's no way you would say that. Our work on these ASTM standards is not meant to bring that balance, that difference rather, between book and market value down to zero. That's an ongoing discussion that differs from company to company and agency to agency and changes over time. And so we just want you to be aware that there are real and tangible differences between book and market. Knowing why they're there is important, and we think anyone would agree that a 3 multiplier, as we've got in this example here, will be material. You know what you can do about it. You can use those differences in the real world. What we try to do is we try to find ways to let that thinking and valuation process be more visible as we enter the latest GAAP requirements for estimation and disclosure of environmental liabilities. So with in mind, we think we had our work cut out for us. We noticed a lot of differences in terminology and presentation in 10K reports, differences where GAAP doesn't prescribe a specific way but sets some solid expectations about the quality of the data and the usefulness. But we heard industries and a range of enterprise sizes in those 800 plus 10K reports. We never found an explanation for when liability balances would top, stabilize, or why spending didn't correlate to liability work down. And the net book versus market valuation differences gave me a direction and momentum. With that, I'll back over to Scott here for the next part of our presentation.
Thanks. I would like to give an overview of ASTM E2137, which is the standard guide for estimating monetary costs and liabilities for environmental matters. This sets out a robust process for estimation of costs and liabilities in a rigorous and defensible manner. It was first published in 2001. It was reapproved in 2006 and 2011. The latest 5-year update was implemented this year. The next will be in 2021. Many possible applications of the standard. Initially, the methods provided may be applied on any occasion where estimation of costs or liabilities is called for, when business decision-making, due diligence in transactions, recovery suits, and other applications like those listed here. My first exposure to the standard was in the context of a cost recovery litigation a number of years ago. This includes guidance on identifying the purpose of the estimate, provides examples of the types of liabilities and pertinent information and factors to be considered with respect to those liabilities, the estimation methods and how they should be used, and how uncertainties should be evaluated and quantified, and then how the estimates should be documented. An approach is selected based on available information, level of uncertainty, and importantly, the intended end use or purpose of the estimate. This slide shows the hierarchy of estimate methods included in the standard in order of robustness or comprehensiveness of an estimate from low to high. From them, no estimate is likely generally inappropriate given the availability of public information, comparable site data, etc. Above is known minimum value, which may include only known costs, but not including complete estimate. and this approach will be difficult to defend and justify over time. The most likely value and range of values approaches are essentially scenario estimates or ranges of estimates, whereas the expected value approach is a multiple scenario-based approach with probabilities assigned to each scenario and to expected cost estimated from the combination of scenario and probabilities. Quoted price is essentially a market price with the least uncertainty. The 2001 version of E2137 contained this frame drawing explaining the calculation of an expected value. Levels of alternatives lead us to the discrete cost of each end node on the far right. All that's missing is the weighting or probability of each, and we can complete our calculation. This is an essential part of preparing a fair value measurement of an environmental liability. But the is knowing which items to include and exclude, so experience is necessary. And again, from the 2001 version of the standard, each branch now has assigned probabilities, and that in turn leads us to the expected value calculation. This is a reliable and proven way to calculate an expected value. But our 2016 ASTM work team thought we could improve the guidance on use of this methodology. In our 2016 update to the standard, we expanded guidance on estimation methods, uncertainty analysis, estimate documentation. We added example lists of environmental costs and liabilities, drivers and modifying factors for those liabilities, and added appendices with examples of estimate methods, site portfolio liability tracking, for updating estimates, and supporting reference material. We have illustrations with thanks to my graphics team here at Exponent. In this illustration, we have restructured the example event tree from the 2001 standard to distinguish between uncertainties we cannot control, such as the depth of contamination, shallow versus deep, second column, how that can be negotiated with others, such as generic versus risk-based cleanup goals in the third column, and decisions such as landfilling versus soil venting as a treatment technology in the fourth column, and with use of standard symbol types to distinguish the different types of nodes in the event tree. We also did examples illustrating scenarios with additional complexities, such as this one showing counterparty risk for one branch of the event tree. This illustrates the probabilities and costs associated with no partial or complete default by a counterparty on their share of a joint environmental liability. Here's an example illustrating scenarios with the added complexity of remedy failure risk for one branch of the event tree, here for soil venting. It illustrates probabilities and costs associated with no failure and failure at different stages of implementation, in this case 30% design stage or after remedy construction, and then a resultant change in remedy from soil venting to landfilling. So these approaches allow entities to explicitly evaluate and incorporate such risks into their assessments of a single liability or for a full portfolio of environmental liabilities. Now I'll turn it back over to John Rosengard to provide an overview of ASTM E2173, the standard guide for disclosure of environmental liability. And just
sorry. Again, thank God. Again, E2170 is the disclosure standard. It was just balloted over the last months. It was approved in September and just published a few days ago on the ASTM.org website. Its full name is given here on the slide, but it's ASTM E2173-16. And you see from the slide here, we did an extensive rewrite. It went from 5 pages to 17. Not that that's a perfect guide of what we worked on, but it's hopefully indicative of the level of effort we put in. 6 new display tables, 2 new flow charts, 30 new environmental liability terms defined. I think we did an effective update to bring this document up to speed. 2010, to give a little context, FASB did their own restating of their portion of generally accepted accounting principles, and they restated the reasoning behind financial statements. So this graphic is basically how the current generation of accountants has been trained for the last 20 or 25 years. And we thought it useful to convert those words into a graphic connecting the terminology that FASB uses to what we see in E2173. The overall of our work, moving from left to right, is to make sure that we're helping when working with the standard to provide decision useful information, which means data is, if you move over to the middle, rent and a faithful representation. Again, these are accounting terms, but this is what we work with. Be relevant, to go to the upper part of that blue box in the center, relevant data has got to provide a predictive value, a confirmatory value about the past, or a mix of both. To be a faithful representation, numbers and accompanying explanations need to be complete, neutral, free from error. I know very easier than done, but that's in the terminology that auditors are trained to look for, and that CFOs and controllers and so on are trained to provide. And to further improve usefulness, moving over to column C, and to close that space between book and market value we've been talking about, we want to enable you to ensure as much as possible that data comparability, verifiability, is timely and understandable. Finally, in column D over to the right, these are the 4 elements of financial statements. I think of them as the sequence of recognizing and measuring an environmental liability. With the open-ended recognition step, the repetitive measurement step, you follow on with internal presentation, and then you go to external, possibly internal disclosures. In order to provide balance to this whole process, FASB at the very bottom of the slide reminds us to apply the cost constraint. In other words, don't say $1,000, estimating $1,000 liability. The materiality constraint. Factor in the size of the enterprise to get context, and aggregate many individual items to get a sense of what the true values are. This carryover from the 2011 standard update, and it covers, again, the 5 different types of environmental liabilities that we've been talking about here and that are specified in GAAP. We've added this red text so that you can see where the individual definitions fit in. What I want to you here is the sequence of the process flow diagram. Number 1, check against the GAAP definitions first. Second, you evaluate the liability itself. What numbers, what probabilities would you assign? Third, you roll that data up. And then 4th, last step, check for materiality. You'll check for materiality first and then decide whether or not you want to do that. This process flow diagram is the same process a CFO or auditor will use. Evaluate the liability, then for materiality, and then later on off the grid, off to the far right here, decide what to disclose. User standards would be taking a risk, to be contrarian for a second, would be taking a risk by, for example, deciding not to disclose because that action, disclosure, hasn't been done before, or assuming immateriality before even evaluating a specific site or portfolio in aggregate. Bring factually similar liabilities inside or outside the enterprise, or deciding that a cleanup needs a budget before it can actually be a liability that deserves to have a book value. Require an enforcement order before booking a liability. These are 2 root causes that end up having to be fixed later, and we just wanted to draw your attention to the value of having this process diagram made in the new standard. Routine update. The GAAP standard setters have been regularly issuing updates and refinements, so we dramatically expanded the number of GAAP references to make sure the standard is more comprehensive than anything else we've ever seen. We recompiled the key references, added in several new sources. So if you've not seen the terms like obligating events and recognition benchmarks, which are spelled out in GAAP to tell you when to update your estimates, we test in because those are ones we work with We work with obligations and not contingencies. So again, obligating events, recognition benchmarks are a relatively younger part of generally accepted accounting principles that started back in 2006. We documented a few other items like the definition of a watch list for future and potential reserve increases to document that space between book and market. We identified several displays of portfolio statistics that we liked or saw in 10K reports or have used elsewhere in our careers. And we also thought it'd be useful to include a background narrative on using different inflation and discount rate assumptions in different circumstances. Let me go first to in detail. I mentioned that we were applying our experience here. Through experience, we found that these 7 columns for building what's called a watch list, there's an escalation list or a high potential call list. We found these 7 columns are most useful for watch list of future potential reserve increases. We think this is the most useful parts in terms of improving ASTM E2173. It's not commonly audited or disclosed because, again, it's trying to bridge that book-to-market gap. It references line items like strategic decisions that might be business confidential or protected under attorney-client privilege. So with those points in mind, we've experienced that this is the single best tool expressing those differences between book value and market value for a portfolio of environmental liabilities. The structure is simple, requires some significant discipline and a lot of experience to use effectively. We'll have to write in and get through this simply here today. First column, this is where we'd express which of the 5 types of liabilities we're working with. Second is the definition of that liability, which property, which environmental nexus we're working with, to understand what's in and out of scope. The third column and the fourth column through the current and future events and recognition benchmarks. Column the current ones, column for the future ones. It's an important differentiation to say this is why our estimate is where it is today, because you're saying not everything has been triggered, not everything is settled. That's normal for every environmental liability, but these columns are incredibly pivotal to say where we are in terms of the 5 or 6 obligating events and the 4 or 6 recognition benchmarks. Clarity you'll find time and again when you come back to this every quarter, every year. That view from column 3 and column 4 is priceless. The 6th and 7th columns provide the basis for the calculations of the book versus market difference. The essential parts are probability of the future obligating event or recognition benchmark even happening, range of dates, and a range of costs. So you got probabilities times dates times costs. That inevitably will give a wide range, but again, with discipline across a large portfolio, that comes the calculations, they're all reproducible, even though they do display a lot of volatility. As information across a portfolio of sites that have watch lists is a company may only do once or twice a year. It's complex and very, very important undertaking, but with the proper discipline, proper experience, it's proven to be an effective tool. So next 2 tables that we've got here on the following slide have come from many 10K reports we've seen in the last few years. The upper part of the page, which is a count of asset retirement obligations, provides confirmatory and predictive information. In other words, it helps us look back as well as to look forward by explaining how large the current portfolio is and whether new projects are coming in as fast as others being finished. In terms of simple site count, in context of spending, like the display in the lower half of the page, you give the reader a sense or enable them to infer the cost of a single site or the average cost to close a site, and trends in the overall balance and the annual spend. From there, how long a portfolio may need to exist or what the ultimate cost may look like relative to book value in row A or row F in the bottom part of the slide. All conclusions that can be taken away from evaluating these 2 tables for the same portfolio. Those G&H at the very, very bottom of the slide, I just want to share some personal experience in looking through 10K reports. We ask information that's usually repeated in another part of a 10K or 20F report with minimal or zero explanation. We think identifying the deferred tax asset value, which is the difference between the pre-tax AO or remediation reserve and then the after-tax impact that will hit the bottom line, That number that's in row G is often all by itself without any context. So after looking through about 800 10K reports, I can tell you that I was really getting skilled at finding ARO numbers. I do Control F, asset retirement, hit search, and then many times I'd be looking at this smaller number that didn't fit the pattern of the numbers I found for the preceding or following year. And keep in mind, 10Ks are getting to be 250, 350 pages long now. I appreciate some shorter, simpler, more useful displays. We put into E2173 as an example in the appendix for the simple reasons that we think users will find it preferable over a page of narrative. This following table, 2173, because these items are just not disclosed either perhaps internally, but not disclosed externally, but they're able to understanding future performance. In other words, provide confirmation and they provide predictive value. Rows A and C should be consistent and reasonable, especially when you're looking at a 3-year or 5-year display. If you're looking at 2 different 10K reports from 2 peer companies and they have wildly different assumptions about pension plans, that's fine today. But we have the same information about inflation and discounts for environmental liabilities as well as the default time horizon. It says a lot about the discipline and conservatism of the preparer. And most every preparer has a good story to tell, that they look out 5, 10, 30 years or even longer in the case of some companies. Where we sky-high discount rates, short time horizons, we expect large annual reserve add-backs from we would from a company that's using a 0% discount rate and a 30-year horizon. And there are some of those companies out there. We found it useful to know if some, most, or even all of the liability is calculating using the preferred expected value technique. Even more bonus points if there's a consistent usage of the fair value measurement technique. Row E, we found it has become more important over time to identify a company or an enterprise's own ability to pay. It's a widely available commercial metric these days, but we've been comparing that data in row E with fellow PRPs, indemnitors, finding their credit rating will determine whether an enterprise is a net accumulator of environmental multi-party liabilities or it's not. And this is just for surplus sites, but for any 2-party transactions, indemnification agreements that all eventually constitute the total mix of environmental liabilities. G and H and I, we showing these metrics may be useful to convey how timely and significant these issues are today. However, over the long term, if a pattern of immateriality emerges, those can still be omitted over the long term. In the portfolio metrics tracking, row A and B display the emerging preferences of regulators for collateralization of environmental liabilities. What does that mean? Years to come, a state or federal regulator might disallow an assertion that a liability is going to get paid by a company, but that require a third-party financial instrument like a letter of credit or a performance bond and have in effect for several decades. These instruments are the collateral in the collateralization process, and they are not free. They're T in addition to the obligation or contingency itself. Remember about the 5 types of environmental liabilities? Guarantees are that 5th type, and these rows explain that guarantees like financial assurance require discipline and experience to measure, since there's just that both environmental liabilities might be counted for the same single site. So as we see with undercounting liabilities, double counting is also a risk too. Rows C, D, and E, we suggest that users display the percentiles between 0 and 100 that they use for each term from the relevant accounting literature that's been around since 1996. These terms were laid out in SOP 96-1 in 1996 without any specific numerical guidance or definitions for what was meant by likely, which is normally the reserve balance, which in turn be the low end or the midpoint of a range, reasonably possible, which is an increment above the likely number, but not a definitive percentile or dollar value or percentage amount above. But in term likely and reasonably possible are followed by the remote number, which is listed in row E here. There's no guidance about what percentile to use. Again, it just says put them in this order: likely, reasonably possible, remote. We use 3 rows, C, D, and E, and then their dollar values in F, G, and H, because we found it to be useful to quantify that data isn't being displayed to the public in terms of percentile, that if it is put out there, it'll convey the conservatism that's already in place, and that there's a consistency in measurement over time. We think those are important points to get out there. They're already out there. We do see companies reporting F and row G today, and sometimes even row H, but just as dollar values. So we don't do this as a wholesale change. We do this as an enhancement of showing the background about what is there. The we think are the items at the bottom. In row A, expect to see a gradual increase because the expectation of regulators to collateralize environmental liabilities. Row C, it be below 50%, although it might be. And it will show an increase over time of moving from 45th percentile, the 45th percentile 1 year, to the 50th, to the 55th percentile over the course of several years. Row H should be increasing only rarely, by exception. The long-term trend is that they should be headed downward. Again, the overall balance in row F might be stubborn, might be steady, might be stable, but G and H should be dropping if all other things are equal. Let's move on to some of the final displays that we've got here of value measurement. As noted before, fair value measurement was initially defined for asset obligations back in 2001. Defined for all types of assets and liabilities in 2006, but environment to jump on everything else. IASB and GASB, 2 other account standard setters, reaffirmed those definitions in 2011 and 2015 respectively. Relatively young definitions for, again, non-companies and non-federal U.S. agencies. All 3 setters, however, ask for the very same quantitative breakdown of a liability into levels 1 and 2 and 3. Level 1, which is explicitly preferred, means you have a quoted price for an identical liability, which, as we know, is not common in environmental liabilities. But this would be like taking a truckload of soil to a specific landfill. That's a market price that you could assess every January of every year and have a rolling forecast of where those numbers are, based on where the market is for the transportation and disposal cost. A level estimate is for similar liabilities, like pumping and treating groundwater at similar rates in different parts of the country. Just FYI, making a regional adjustment for labor rates, net easier, thanks to web-based resources like the U.S. Department of Labor's cost factors from sources like RS Means. It's never easier to get adjustments when you know one site that has one set of issues, and then you've got another site with a similar set of issues and need to project what the life cycle costs will be. Level basically for components that don't fit into the level 1 or level 2 definitions. First, what are you going to be using this when you apply this? Number 1 is you're showing that vague level 3 estimates are hopefully on the way out, and they're going away maybe at an accelerated rate. This is an accomplishment from entirely wiping out liability because this is de-risking. As on the previous slide, you want to find ways to communicate that you're taking risk or escalation risk out of the portfolio. These you can measure it and measure your effective de-risking of a portfolio because that's also important to your enterprise, and this table is a way to communicate that. Second, you're going to want a bias to determine whether an estimate is level 1, 2, and 3 at a lot of different levels, but if your default is to look at the site level and say, we're just going to look at the entire site estimate and decide what that is level 1, 2, and 3. I'll see the effort. Everything at a site level, look at level 3. Everything is a snowflake. It's a unique, original calculation. It tells you dive deep, look at the components of that estimate, and make that decision on the component level, like the study cost, the remedial design, the allocation effort, remediation, O&M, overhead. Make assessments at the component level. I know a little extra work, but it'll also give a sense of progress. Because I think that applying these level 1, 2, and 3 definitions, starting back at the watch list, and also applying it to the current budget and reserve is a way to encourage thinking and to improve the clarity about measuring the long-term suspended. With mind, our simplified take on 2137 and 2073 is that we're to make the differences between book and market visible to us. We're trying to explain and monitor them. The gaps have changed since these ASTM standards were first issued in 2001, and suggested displays that we've just covered capture best practices that we see applied by some, but not all the enterprises, using material and environmental liabilities. We made some changes to the standards to build sites into these chronic needs. So we think these are questions, big questions, that everyone is trying to answer. Number one, liability reduction matched with spending, are highly correlated. So spending at the right level to keep book reserve balance in check while not letting a market value run away from us and be out of control. Third, do we look at our contracts and our promises to make sure we've reliably booked our liability numbers? The fourth item, do we know our life cycle costs well enough to use them in our cost sharing or recovery work? And finally, have we booked our AROs at a proportional level to our asset base? With that, do we have capacity to keep that balance stable? We have some examples here, and I just wanted to talk through a case study to use leading, trailing, and current indicators with this framework in mind. This isn't part of the standard itself, but we think talks through where you can get some utility out of this. So this case study, and look at the bottom of the graph for starters, and we're looking first at the green bars at the bottom, which are displaying cumulative costs. In other words, we've grown from spending a few $1 million 20 years ago to now a total balance, a total incurred sunk cost of around $5 million. But note the last 5 or so, we have this cost to close forecast curve jumping off of each respective incurred cost numbers. If you have the trends in just those life cycle cost to close forecasts, it's like every year of waiting adds about 15% to our life cycle cost. That's good. With this, we understand that time isn't our friend. We may need to rethink our options, but if we don't get problems this way, it just looks like looks like a money pit, which is bad for the property, bad for the liability, and so on. Incorporate what we've got in ASTM E2137 and 2173, trailing indicators like our spending, and we start to use current and leading indicators like our reserve and our forecasts. I know I'm here today, I just want to give you a sense that by comparing your watch list to your reserve balances, you get a current understanding of where that book versus market value gap is, how you can quantify it today, and how you can manage that going forward. This one, which is the green bordered value in the background, you'll see that it's generally trending downward, and the reserve balances are piling up in the foreground or at the bottom half of our chart here today. What is a normal behavior for a very, very long-term site? Reserves are added as more information comes in, and over time, as we de-risk the site, de-risk the portfolio, we see the watch drop down as negative outcomes or ranges of outcomes become more certain and ideally less expensive. Those last two slides, last two sets of data, we see a couple of things. Number one, reserve balance is only a current indicator of liability. Spending is a trailing indicator. If we're focused on comparing spending versus reserve, managing liabilities, we're watching a trailing indicator and a current indicator. We're not looking at any leading indicators. If you look at the twist, which is our only leading indicator from our forecast, we see that we're slowly turning our our liability into reserves and then to spending, squeezing out some long-term risk, which are the drops in the watch list, and now we understand that liabilities are getting discharged. However, some of your spending just helps you recognize or measure the liability, and in others, spending really does dollar for dollar work down that liability. We anticipate that this site is going to have a few more reserve increases in the next few years, so with that in mind, we want to show you the final use of the watch list, which is to come up with a delineation of the decisions and uncertainties of the infrequent future reserve increases. By using a watch list and fair value measurement and knowing that we are closing the space between book and market value by tracking our recognition benchmarks and our obligating events, We can put our future reserve changes as the probability-weighted ranges of cost and timing that they truly are. This is distilling in a lot of information down to just when reserve increases can occur, but understand there are ranges in timing, which are the horizontal bars, and ranges in cost, which are the vertical error bars. Expectations and experiences are that when you have your numbers and thinking process clearly presented like this from E21, 37, and 73, you're likely to make better decisions with your capital. We wanted to give you some ideas about applying these standards right now. Before we do, remember where you're headed. Your enterprise is going to be healthier and protected from surprises if you know the differences between your book value and your market value, where those are coming from, and how to manage them well. So start by using this rollout of us announcing that E2137 and E2173 have been revised. This event to advise your work team that reevaluations may be timely and necessary. You look at your reserve policy, maybe the way reserves are set. You use list if you have something like that in your organization, and back up on the best practices that we contribute and spell out in 2137, 2173. Secondly, where your enterprise is today. Is it growing, investing, spinning business units off, reducing costs, merging? Understanding where are the moments when reevaluating policies and procedures and tools in place. It's important to build consensus for closing any data gaps that are out there. So we recommend, since you probably have more than enough data to get started, you have the challenge of getting your data organized. You probably have plenty of information. It's just not structured in a way that you can use today. So to build consensus, we think you'll benefit from an objective evaluation of where you are today and what kind of multi-year adoption plan you'll need to have in place, and do an implementation trial run on a subset of your portfolio. If all goes well, it's probably time to formally endorse to proceed internally and train the teams that will implement that data gap closure plan over a series of years. If you choose to implement a data gap closure plan, decide how often you need to evaluate your reserves and what financial controls you want to have around them. It's a good time to visit that. See your resources for market prices so you can keep your forecast accurate at the lowest possible cost. Fifth, and finally, remember that you want to measure how you're improving your results. You're putting updated ASTM standards to work for you. Our work teams expect that you will improve your business, clean up more ice with less capital, and close the market gap over time. We think the good news is that you proactively work this through now. You'll benefit more today than for doing it under pressure later. With that, over to Scott to conclude our presentation.
Thank you, John. So talked about how changes to GAAP encouraged the ASTM standards updates, how to confirm whether you're looking at all types of liabilities and their full life cycle costs, new factors to consider for improving cost recovery and insurance claims and claims review, new to help you prioritize spending and avoid surprises. So in terms of next steps, how can we help? John and I are both passionate about helping professionals like you to work through this challenging intersection of business and the environment. First, you probably need to build awareness among your colleagues, as John was discussing, and teams regarding these new ASTM standards, which encompass and reference the change and gap that are already in place. From you will likely want an objective outside review of your current practices and processes, see how these new standards can support your people, your projects, and bottom line. Or you want to revisit estimates of liabilities in consideration of cost recovery litigation or insurance claims. We help and would enjoy the opportunity to work with you on implementing these improvements for your business or practice. Thanks. Any questions?
You do have a couple of questions. I think the first one here is for John. If you can go back to slide 17, the question is this average of 4 companies?
Let's give me a moment here to cycle back to
use the arrow if you want, John.
Great.
Well, we get to that question. In the meantime, another question. What is the relevance of the ASTM standard to the actual practice in industry? Is it guidance or actual? We've got 17.
17, this is one company, and this is their average over the 21 or 5-year time span. This is just a single company, totally unrelated to the ones in the previous slide, or two.
So,
the AS standard relevance, we've seen some of our clients cite the ASTM standard in their reserve policy guidance. It's already part of their DNA and how they do their calculations. So it's a way of accumulating the references to GAAP, which reserve policies already do. So we think that the nexus, the usefulness of this is in training key personnel to say, don't try to dive into GAAP, don't try and CPA, apply what it tells you to do. By applying the ASTM standard, it's only 17 pages, it's not 1,000 pages. It's a more efficient way of taking what you need out of GAAP and applying it to your portfolio.
It does get used in, referenced in litigation as well.
So we have one final question. There seems to be a wide range of time horizons for calculating reserves. Is there a minimum or maximum requirement under FASB?
Fantastic question. GAAP, whether it's from FASB for U.S. companies, GASB for federal public agencies, ISB, nobody gives out a time horizon. No one says 30 years is enough or 60 years is too many. No one says at least make it 5 years. No one has a time horizon. That's all in the discretion of every individual organization and how you think GAAP applies to them. So no authoritative span.
Ladies and gentlemen, thank you for joining our webinar today. On your screen, you'll see the poll I mentioned earlier. I hope you'll take a minute to complete the questions for us. This concludes our program today. There will be a full recording available at our website at www.exponent.com, and each of you will also get a certificate of attendance as well as a link to these slides. Thanks again for joining us today. Hopefully, you'll see us again in the future. This concludes our program.
Thank you for today. This concludes today's webcast, and you may now disconnect.